The mark of financial success isn't about getting bigger, better, faster, or more. To Paul, success is freedom. Freedom to spend more time with his family, or giving back to his community, or just more time to go surfing. Paul Glossop, an award-winning property buyer and regular guest on the Smart Property Investment Podcast, has taken the lessons he's learned building a multi-million-dollar property portfolio and laid them out in his best-selling book, A Surfer's Guide to Property Investing. For a limited time, get your free copy of Paul's award-winning book and receive a roadmap for building both lifestyle and wealth through property investing. Grab your free copy today at purepropertyinvestment.com.
This is a Momentum Media production.
Welcome to the Smart Property Investment Show, the podcast by investors for investors.
Hello, everyone. Welcome to a very special episode of the Smart Property Investment Show. I'm Grace Ormsby, and I'm joined via Zoom by someone who knows an awful lot about the Australian property market, and to talk all things profitability at the moment and what we can expect coming into October. It is an absolute pleasure to welcome Eliza Owen, the Head of Research at CoreLogic, to the show. Eliza, how are you going?
Grace, thank you for having me. It's great to be here.
We are at a really weird point in time, aren't we? In that we haven't seen that normal spring selling season. Before we jump into this pain and gain report, which is what we're going to be focusing our attention on today, what's it been like for you? What have you noticed in over September especially? Because really, in New South Wales, not much has been able to happen. The same can be said for Victoria. So what are some of the indicators looking like from your perspective?
Yeah, having had the hindsight of lockdowns in 2020, some of the trends that we noticed then and we thought would apply this year basically included a decline in both sales volumes, so people out buying property, but also listings volumes, people not really wanting to sell during lockdowns and not really having to sell during lockdowns either, because we do see those lockdown periods associated with lots of household income support, so people can keep servicing their mortgages if they need to. They're not forced to sell. And we did see the banking sector reintroduce loan repayment deferrals for those who were really struggling as well. So essentially, we did see a lot of those same patterns through the September quarter, where listings volumes fell, sales volumes fell. But what was really interesting is that in an environment where you've got continually falling mortgage rates and consumer sentiment being a lot more buoyant through lockdowns in 2021, the impact wasn't as bad, especially in New South Wales. And I think a lot of that had to do with the fact that our restrictions still allowed for those physical one-on-one inspections of property. And that really created a divergence between what we saw, say, across Sydney's auction market versus Melbourne's auction market, where Sydney had higher volumes. It sustained a clearance rate above 75% for the September quarter, whereas in Melbourne, you had a lot more properties being withdrawn and rescheduled. That weighed down on the clearance rate, and volumes were a lot lower as a result as well. And what's interesting is that as soon as the Victorian government allowed those physical inspections to start taking place again towards the end of September, we immediately have seen an uplift in volumes across Melbourne in the past couple of weeks. We did see a bit of a decline in sales and listings volumes, but again, it's not as dramatic as what we saw in 2020. So I think overall that's been positive for the real estate sector. But we are expecting through October, November, we'll just get a bit of a lagged spring selling season, and volume should hopefully pick up even more in the next few weeks.
Well, really, they've maintained their increases, and they are going for a lot more than maybe they were valued at a year or so ago. How much of that do you attribute to the supply not being there?
Well, I think the supply not being there is a pretty big factor. A consistent trend that we've seen for many months now is that there are more sales happening than every new fresh listing added to the market. So that means that buyers are purchasing new listings and the, I guess, more stale listings that have been sitting there for a while. Even if there was a bit more supply, it's important to remember that the demand side falls during lockdowns as well. And when you get that kind of concurrent fall in both supply and demand of property, the net impact on prices isn't really very significant. As it is, we've still got very accommodative monetary policy, so a 0.1% cash rate that's continuing to see these declines in mortgage rates. So that's all supported prices, which nationally are now up 20% over the past year.
Which is just some crazy figures. How long has it been since we've seen that kind of jump?
That is the highest annual appreciation we've seen since June of 1989, when we saw a lot more liberalisation of the financial system. We saw a share market crash in the 1980s that saw a lot of people start pivoting towards property. And property values were inherently low in the 1980s, so it makes sense that you'd see those kind of big percentage gains. What's so interesting about the current period is that prices were already pretty high, and now they've risen another 20%. At the national level, a typical dwelling value has risen with that 20%. If you apply that to the median value, it's an increase of over $100,000 in the space of a year. So, I mean, again, it's a function of low interest rates and people just being able to borrow more. But what we are starting to see in the monthly rates now is that affordability constraints are starting to weigh on the monthly growth rate. So even though your annual appreciation of values has been 20%, in the month of September, it was 1.5% gains, which is actually the slowest monthly increase we've seen since January this year. So property is still going up, but the rate at which it's going up is continuing to slow down. And it looks like the peak growth rate for the current cycle was back in March this year.
Okay, so things are settling down, but I think it will be interesting as well. And I want to touch on it a bit later in the episode, that APRA has now brought in those increased lending buffers, which are going to weigh heavily on, future affordability and what people can actually afford to spend when they're buying. But we'll get to that in a little while, because I do want to jump straight into this pain and gain report. It's all based on the June quarter, isn't it? Which for me, it's hilarious to think about at the moment, because we literally went into lockdown pretty much straight after this period began, and we've been in lockdown ever since. So that's why I think it's a really fascinating report to be unpacking, because really it's a snapshot in time, isn't it?
It is. And one of the reasons that this report is a bit lagged is because we want to be able to collect as much resales data as possible to analyze. So this whole report is basically based on raw transactions where a property will have sold in the June quarter. We're observing the previous sale of that property, how many years ago it sold, what it sold for back then. So it is interesting to see. My expectation, though, is that, and we'll talk about the high levels of profitability in this report. My expectation is that those high levels of profitability will have been sustained when we look at the September quarter, because we know that prices continue to go up in the September quarter. It's just that the transaction activity on which the analysis is based will be a bit lower, because there won't have been as many listings taken place, particularly across New South Wales, Victoria, and the ACT.
And that's something as well that I do want to touch on in a bit. It's going to play into what happens when we do eventually get our spring selling season. We're going to bring in a lot of supply into the market. We're going to be bringing a lot of demand, aren't we? And so maybe we won't see any more growth in those figures, but there's a high chance that it could stay relatively stable. Is that a fair thing to say?
Oh, absolutely, Grace. I think the level of profitability that we see in the Australian real estate market is just tied to capital growth patterns, right? So even in this report, we've seen an increase in the rate of profit-making sales through the June quarter. But much like capital growth, the rate of increase in profitability hasn't been as sharp as what we've seen, say, earlier in the year when there was that kind of peak momentum in the market. But I would expect a lot of people will still be able to make nominal gains on their property through those September and even December quarter sales.
And we're going to be talking some pretty crazy figures, so we might take a break there. We'll be back soon with more from Eliza Owen.
Are you wondering where to buy an investment property right now? Why not let buyers take the guesswork out of it? We can find you the right place on or off market at the right price. An investment professional from our national network of buyers agents can help you save time, money and stress and deliver you a tailored solution. Talk to us today. Call 1800 975 051 or visit buyersbuyers.com.au.
Welcome back to this very special episode where we're talking to Eliza Owen, the head of research at CoreLogic. Eliza, we are talking through the Pain and Gain report, which it talks all about profitability and holding cycles really for property and how long people are holding onto property before they get rid of it and what kind of profits or losses really are associated with those patterns in Australia. And it's a really fascinating report, and it gives a sense of what's actually going on in the market and consumer sentiment, as well as what's actually possible when people are holding on to property. For investors especially, it's some pretty interesting insight into how much profit you could actually make from a property the longer you hold it.
So I think the report has often touched on this idea that property is a long-term game, and the more you hold on to your property, the greater the nominal return you're likely to get. So the report features a kind of median return for years of property held. And the June quarter analysis shows that for those that had held their property for 30 years or more, the median return was $712,000. What is so interesting about the more recent results, though, is that even those with really short periods have made substantial profits on resales. So through the June quarter, those that held their property for just up to 2 years have made a median gain of $123,000. So in terms of your profit by year, it's actually those people with shorter hold periods in the current cycle that have done really well. But that's not necessarily the message that we want to send, because that is just a function of the current phase of this cycle. Once we move into a downswing, it's much more likely that people with those short hold periods might actually start to lose money. But in the current environment, I guess it does show that there is a bit more flexibility with selling at the moment, particularly for those that find themselves in financial hardship because of COVID. The fact that we've had low interest rates means that you're in very little chance of negative equity in the current environment. So in that sense, it sort of ties into the RBA strategy and how that's added to financial stability through the current period.
It is really fascinating as well, isn't it? Because you do calculate, that profit point after 2 years, 1 to 2 years, and it doesn't equal what it is after 30 years. So I know that the median hold is for 8.8 years. Has that been shortened or lengthened at all? Like, have you seen people tempted to go into the market because people are achieving such amazing results at the moment?
Yeah, so generally it is, the hold period had been increasing over, the past 5 years. And there is a slight distinction where the hold period on profit-making sales was slightly higher than those on loss-making sales. So it was 8.9 years for a profit-making sale and just 7.9 years for a loss-making sale, noting that when we talk about a loss-making sale, only about 8.5% of properties sold in that period actually did make a loss. So that's only a relatively small segment that we're looking at. I would expect that hold period is going to come down and that the current market conditions are going to incentivize more people to sell up. The only caveat to that is they need somewhere to go, first of all, and they need to have the mobility to have somewhere to go. And that kind of comes with more eased restrictions and more listing supply coming onto the market. That will obviously sort of weigh down a little on the profits when you get more supply. But ultimately, I think we are going to start to see more people sell up when restrictions related to COVID are more eased.
I think there's some great news in there for agents and investors and anyone who's looking to get into the market, myself included. You know, there's not much going on out there, and so it is one of those things where you're kind of looking at it going, well, do I bother now or do I wait until I see what else is out there? Because we are in a lockdown situation. That's the most important thing to remember at the moment, isn't it?
Yeah, 100%. Look, over the past few weeks alone, we have seen more new listings coming onto the market. The question is, are those listings coming onto the market in the areas that people want to buy? As we've seen restrictions easing related to lockdowns, I think the inner city unit market's the first place we've seen a lot of supply popping up. Supply has remained really elevated across the Melbourne council region, for example. It's not necessarily where a lot of people want to buy right now. I think it's worth noting that those areas present some opportunity as a result, like the fact that they're not growing as quickly, the fact that there is lots of choice for buyers. You know, for those looking to start off with an investment property, then there may be some reality. But at the moment, your really desirable areas like the Mornington Peninsula, the northern beaches of Sydney, the Central Coast, these are areas where supply levels are still pretty tight.
For sure. I want to get now into some of those headline figures that are contained in, because it does go against, Ballarat in Victoria, that was one of the highest levels of profit-making sales in the June quarter, wasn't it? And would that traditionally be one of those northern beaches, Mornington Peninsula kind of spaces? Like, I wouldn't think so. Obviously, it's close to Melbourne, so it's going to be, benefiting from that. But it's probably never really been considered as a really hot market.
No, I mean, in terms of high levels of profitability, it has those higher end lifestyle markets that have returned the highest incidence of profit-making sales and also the highest level of profit as well. But what's so interesting about the current market is that we have seen the normalization of remote work promote this kind of tree change. I think it has also brought forward a lot of retiree decisions, a lot of tree change decisions, and that's something that's really boosted profitability in the area as well. And Ballarat would also have slightly higher hold periods because of the nature of that market as well. It's a lot more owner-occupier. But basically through the June quarter, 99.7% of resales made a profit. And that is the highest rate of profit that area has seen historically. And that speaks to regional Victoria, where, there's a very high portion of profit-making resales as well. The profitability across all of regional Victoria was sitting at a record high. And that's certainly boosted by Ballarat and the other sub-markets that have seen very strong results. In terms of other markets, we've seen the Sydney house market saw a profit of 98.7% in the June quarter. And that's also sitting at the highest level since the 1980s as well. So 97.6% to be exact. So yeah, that's the highest level in Sydney houses since the 1980s, which again is very similar to what we're seeing in capital growth trends.
As you're talking with the capital growth trends, and markets by virtue are cyclical in nature, do you see the same kind of thing happen with the pain and gain report and profitability levels? Is it, does it get to a point where then it naturally has to fall again?
Oh, yeah, it will. And that comes back to when property prices start to fall. The more that property prices are falling, the higher the chances are that out of all the observations that we're looking at, there are going to be more loss-making sales. And we've seen that historically. There's broadly a correlation between capital growth and the rate of profitability in the housing market. But honestly, for those who hold on to their property for a long time, because over time capital gains have generally seen property values rise, it's about time in the market, not timing the market. There are exceptions to that, of course. In Perth and we saw a housing market downturn that lasted the better part of 6 years. And although that market is turning now, we do still see a relatively high incidence of loss-making sales, which at the June quarter was still 22% of all resales. And across Darwin, it was 34% of all resales. So when you compare that to, less than 2% of sales across regional Victoria making a loss, I think the long downturn that we've seen in those resource-based markets really stands out. And, it's really not great for sellers. The good news about those resource-based markets is that they've also had the steepest declines in the rate of loss-making sales. So, for example, Darwin is 34% loss-making sales in the June quarter, but that's down from 38% in the March quarter. So there is that improvement we're seeing in the market, but it is still that big overhang from a long resource-based downturn.
I did find it really interesting how closely you could interrelate that to them being resource-based markets, because, we have started seeing a little bit more of a lift in the Perth and Darwin markets on a lot of other metrics. But the fact that this actually is relating to what's going on over there, as well as the fact that they, haven't been in lockdown for as long or as tough as the eastern states have. It's just some amazing research there.
Yeah. Oh, thank you. But it is true. Being out of restrictions doesn't hurt the market at all, right? But it's also tied to the fact that mining employment has increased substantially. There's been an uplift in just private mining investment, which creates more jobs, creates higher demand for housing. And when you talk to some of the agents on the ground, like in the Pilbara region, for example, they just do not have enough housing. The impact of COVID is that the workforce has had to transition from a FIFO workforce to a local workforce, basically, because of the state border restrictions. So that's created a very immense, concentrated period of housing demand. I guess the only thing to note for investors looking in that area, for example, is that because of the nature of those markets, they would also be affected by the next mining downturn. So with some of what we're seeing, in China and, trade tensions, the long-term move to renewable energies, and just some indicators of economic weakness in China, which, receives the majority of our iron ore. Those are things to keep in mind. The Perth and Darwin markets have been through vast improvements, as have regional markets across Western Australia and the Territory. But there are just those things to keep in mind that can be a market that is very tied to that resource performance.
There's some really interesting insights there, and I hope everyone is listening and taking notes, because a lot of this information, it is a snapshot in time, as I said, but it's going to have an effect moving forward, especially, as some of those macroeconomic factors do play out. But we'll be back soon with more from Eliza Owen.
In the property investment industry, there's countless stories of the one that got away, and it's always the same reason. To pay the deposit, they needed the settlement from another property to come through, and they waited. Realty Assist Australia knows that when you find the one, waiting isn't an option. That's why they have a same-day settlement fund advance service. There's no credit check, no application fees, just a single one-off fee to advance your equity. Visit realtyassist.com.au/settlements now.
Welcome back to this very special episode, all about research, all about what's going on in the market at the moment, a snapshot in time, as we've said a couple of times this episode. Eliza Owen, welcome back to the show. You're the CoreLogic Head of Research. You've put together this report, which gives an amazing insight into profitability levels and holding periods for properties, what you kind of need to be doing as a buyer or a seller to be making money on property really in Australia. And we have seen record levels of profitability from people selling property, which you said in the report, Eliza, is sort of a testament to how resilient Australia's property market is, which is crazy as well. You think back to 2020 and all the doom and gloom predictions that were coming around in March. It's been amazing how how well Australia's property market has bounced back from that, isn't it?
It is extraordinary. I think the consensus around outcomes for the property market at the onset of COVID was this peak to trough decline of 10%. The peak to trough decline from COVID was actually 2%. And since March, we've seen double-digit growth across the market. And a lot of that was not, we talk about the resilience Australian housing market, but a lot of that was the protection of the Australian housing market, I think. It was the institutional response that people really underestimated. We didn't expect the banking sector as a whole to say, okay, we'll pause mortgage repayments. We didn't expect a cash rate of 0.1%. And I think especially from the coalition, maybe we didn't expect the levels of increase to, job seeker and job keeper. So it really was a lot of those institutional responses that kind of saved the housing market through this period in a way, and have enabled us to get to a point where we can reopen, we can pick up economic activity, and then we'll see, I guess, housing tied more back to those fundamentals of employment growth and population growth and things like that. So it's very good news, especially if you're in the real estate sector, and that continues to be in these pain and gain results as well.
It definitely firms up that widely held view that bricks and mortar is where you should be looking as a sure thing investment, doesn't it? I want to jump in now to some of those micro parts of the report you're talking through, like the houses and units and differences between owner occupiers and investors, because they all occupy different parts of the sector. And according to this report, they have had different levels of profitability, haven't they? Like it does actually have a material impact on how much money someone can make.
Across the unit segment, we've seen a much higher incidence of loss-making sales at about 15.3% in the June quarter. Units historically have tended to see a higher level of loss-making sales because they have shorter hold periods, and particularly through COVID, they've been subject to more hurt through the closure of international borders, because a lot of these units are investment properties, particularly in the areas where we see really higher concentrations of loss-making sales, like Melbourne, where almost 35% of property sold at a loss across the Melbourne LGA in the June quarter. These are investment properties that are relying on tenants, a lot of them coming from overseas. So that's where we've seen a lot more subdued performance and a lot more hurt for sellers. And similarly, we see that the investor segment of the market, investor resales saw a rate of loss at 12.3% compared to just 6.1% for owner occupiers.
There is that is a very interesting distinction between owner occupiers and the investors there, isn't it? Are there any concrete reasons as to why that was? Is it shorter hold periods? Is it that, owner occupiers maybe were occupying more lifestyle housing that people were interested in and have been interested in through COVID-19? Can you talk us through that a little bit?
Yeah, Grace, I think it's definitely both of those things. We do see a bit more turnover in the investor segment and slightly shorter hold periods. I think because investors can potentially claim losses against future gains in property, they may be more willing to cut something if it's not making a profit for them, if it's not working for them, and it adds to the supply and the downward pressure on prices as well. In terms of the owner-occupier properties, I think you're exactly right. Owner-occupier is the dominant buyer in the current cycle. So I think that ties into why they're more appealing and more profitable as well. But even without the trends that we're seeing in this particular cycle, long-term investment properties have always had a high loss-making sales. Of course, it varies market by market, but that's what we see at the kind of national level. It's worth noting in markets like parts of Tasmania, for example, because profitability is so high across the whole market, we do sometimes see profit-making sales in the investor segment eclipse owner-occupiers. So there are a few differences here and there, But the broader trend is that owner-occupied properties and detached houses are more profitable.
Which is interesting as well, because then you've got, the attitudes that are held by owner occupiers. And it's usually, if this is our forever home or we're going to be living here for a long time, we don't really, we're not too bothered about, whether it ends up making us money. But it's kind of almost a surefire thing, especially in this kind of market, isn't it?
Yeah, if you're holding for a long time, if it's a forever home, I think that's a pretty safe bet in terms of profitability. But you're right, there might not be as much concern as to whether it's making a profit in the short term or not.
Eliza, that brings me to we're nearing the end of the episode now, but I do want to ask if you think that we've hit a peak. Obviously, those figures were amazing coming through from June, but since then we've been in lockdown for 3 months. The report did mention that, there were headwinds that were coming, and we've seen that. I do want to read out one little part of the report, if that's okay, where you say it is the incidence of profit-making sales will decline when housing market performance starts to soften. This will likely occur off the back of a change to lending conditions, whether through increases in the cash rate or the introduction of macroprudential measures around mortgage lending. And this week we have seen that APRA has jumped in and lifted the buffer, widened that lending rate between what people are borrowing now and what they potentially can be paying off a mortgage up to 3%. And that's going to have a massive impact, isn't it? But will it be enough to stall what we're seeing?
Yes. So hindsight is 2020. And I guess one thing that we should have expected was that the macroprudential interventions may be a bit more subtle this time round. I think APRA has been really proactive with that introduction of an increase to the serviceability buffer. So, having looked at it now, it's probably not going to be enough to trigger a downturn in the market. And an increase in the cash rate and an increase in mortgage rates is probably going to be a much more powerful factor. It is worth noting that APRA did sort of flag in their letter to the banks that there may be more to come, particularly in that high debt to income lending space. But for now, it sounds like it's quite complex to implement anything around that just yet. So I think overall, the changes that we're going to see in the lending space, probably won't have too much of an impact. I mean, serviceability assessment has gone up from a 2.5 percentage point buffer to a 3 percentage point buffer. But what's important to note is that banks had to use what was higher between a floor assessment rate and the buffer. So even though the buffer's gone up a little bit, it's likely that for owner occupiers who have a relatively low mortgage rate at the moment and have a much more dominant presence in the market, they were probably being assessed on that minimum floor rate anyway, which was pretty high. So when you add a 3 percentage point buffer on a product rate, that might end up being the new thing that they get assessed on. But because they were used to that floor rate, it's not that much of a change for owner occupiers. It's a very subtle, very clever piece of targeting that APRA has used in this policy, which will probably actually make more of a change for investment lending. The anecdotes or the feedback that we've heard from the industry so far is that this probably wouldn't have much of an effect on their lending portfolios. So again, I don't think it'll make much of a change, but I've been wrong before.
I mean, it could be, as you said, a sign of things to come, and it is a space that we're going to be watching very closely. But I echo your sentiment in that it is very clever. Like they've made a stance, and probably no one expected it because they did decrease that buffer so recently. But it was before COVID happened. It was external to the COVID situation that we've seen, and we first saw rates go down. We've seen intervention by the banks, and all of those influences coming in to try and do something about the housing market. Whereas APRA with their serviceability buffer rate hadn't really had a say since, when was it, 2019?
2019 was when they started repealing some of the macroprudential from the previous cycle. And it was also when they replaced that 7% floor with the 2.5% buffer. So yeah, I think I actually had someone message me on LinkedIn and say, hey, have you written anything about this yet? Because the APRA's change is pretty underwhelming. And I was like, that's such an interesting word to use. I genuinely think it is not necessarily underwhelming, but just a lot more subtle. And at the end of the day, they're not concerned about housing prices or housing affordability. They're concerned about financial stability. So we already have a very strong financial system, very strong capital ratios. So I think that, yeah, this is just a subtle kind of tweak. It's going to probably target investors a little more. And we'll be keeping an eye out from anything else that comes from APRA as well.
Well, I guess in the meantime, it's just going to be Australia start to open up a bit more, especially in the eastern states, and just see what happens. But are you expecting spring to pick up some steam heading into summer?
I think we'll see. I mean, we're already seeing some more supply coming on the market in the past couple of weeks. So I think that between the increase in listings volumes and the easing of mobility across Australia, we're going to see a lot more transaction activity. Just depends whether that supply starts to outweigh the current levels of demand as to whether prices keep the kind of momentum that they have. But definitely the easing of restrictions has been associated with a pickup in transaction activity. So a good thing for agents to be taking advantage of that.
Eliza, thank you so much for your time today. It's been an absolute pleasure, and I can't wait to have you back in a couple of months and we can talk through all of this and see how much of our crystal ball gazing did come to be. To everyone who is listening at home, I hope you enjoyed this episode. Please like or review us on whatever platform you're using to listen in. If you have any questions or you think you might make a great guest on an upcoming episode of the Smart Property Investment Show, reach out at editor@smartpropertyinvestment.com.au. Make sure you're staying up to date with us on our social media, our Facebook, Twitter, and our LinkedIn, as well as on the website where you'll find all the latest property investor related news, smartpropertyinvestment.com.au. That's all we have time for today. Until next time, bye-bye.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs and should not be relied upon. Before making any investment, insurance, tax, property or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.
The mark of financial success isn't about getting bigger, better, faster, or more. To Paul, success is freedom. Freedom to spend more time with his family, or giving back to his community, or just more time to go surfing. Paul Glossop, an award-winning property buyer and regular guest on the Smart Property Investment Podcast, has taken the lessons he's learned building a multi-million-dollar property portfolio and laid them out in his best-selling book, A Surfer's Guide to Property Investing. For a limited time, get your free copy of Paul's award-winning book and receive a roadmap for building both lifestyle and wealth through property investing. Grab your free copy today at purepropertyinvestment.com.